Have you ever wondered why some stocks feel so easy to buy and sell, almost effortless, while others can feel like a trap? And why do trading costs, which are usually tiny, suddenly explode when the market gets stressed? Well, let's talk about that. You know, the answers to these questions aren't really found on company balance sheets or in the big economic forecasts. Nope, they actually lie deep within the market's hidden plumbing, a really fascinating field of study we call market microstructure. So, welcome to Chapter 1.4 of our Finance Masterclass. In this session, we're going to dissect the three core variables of market microstructure. These are the things that determine the real and often unseen costs and risks you face with every single trade. All right, let's start by breaking down the three fundamental ideas that really govern how the market mechanics work: liquidity, the bid-ask spread, and volatility. Each one of these is a crucial piece of the puzzle. First up, liquidity. Now, conceptually, you can just think of it as the ability to exit a position, but it's actually got three key dimensions. First is speed. How fast can you trade? Second is price impact. How much does your trade actually move the price? And third is market depth. How big of an order can the market handle? For instance, a Nifty 50 stock trading on the NSE is super liquid. It can absorb huge orders with almost no price impact. But on the other hand, a really illiquid small cap stock, well, its price might just plummet if you try to sell even a moderately sized position. And it's absolutely crucial to understand that liquidity isn't a simple yes or no thing. It's not binary. It exists on a spectrum. High liquidity environments, they're buzzing with lots of buyers and sellers, which means you get tight bid-ask spreads and really low transaction costs. But on the flip side, in low liquidity environments with just a few participants, that spread widens out dramatically and your cost to trade just explodes. And that brings us perfectly to our second concept, the bid-ask spread. This is the direct, explicit cost you pay for the privilege of trading right now. So if the bid price is 500 and the ask price is 501, that 1 rupee difference, that's the spread. Think of it as the market's fee for immediacy. But this spread isn't just arbitrary profit for someone. It's actually a calculated compensation for three very distinct costs. First, you've got order processing costs. These are just the operational expenses of running the whole system. Second, there's inventory risk. This is the risk a market maker takes on by holding a stock whose price might drop. And third, and this is a big one, is adverse selection. This is the risk of trading against someone who knows more than you do. If a trader has some superior information, the market maker is basically guaranteed to lose on that trade, so the spread acts as their protection. That risk from information asymmetry is a critical part of the spread. And finally, we have volatility. Now, it's so important to distinguish this from risk. They're not the same thing. Volatility is simply the size of the price swings. Risk, on the other hand, is the probability of a permanent loss of your capital. For a market maker, higher volatility directly cranks up their inventory risk because the value of the shares they're holding could change dramatically in just a few seconds. Okay, now here is the most important part of this entire chapter. These three concepts we just talked about, liquidity, spreads, and volatility, they don't just exist in a vacuum. They are locked together in a powerful, self-reinforcing feedback loop. And this brings us to the market microstructure triangle. You can see how these three forces are all connected. Low liquidity creates price instability, right, which shows up as high volatility. This increased volatility then raises the inventory risk for dealers, and that forces them to quote wider bid-ask spreads to protect themselves. And finally, those wider spreads make trading more expensive, which of course discourages trading activity, and that brings us right back to where we started, low liquidity. Let's trace this vicious cycle step by step, just to make it crystal clear. It all starts with low liquidity, where even small trades can cause big price swings, creating high volatility. In response to that, market makers widen their spreads to shield themselves from that increased risk. But these higher transaction costs discourage traders, which reduces participation and dries up liquidity even more, just reinforcing the cycle. This is exactly why markets can become so fragile under stress. So, how does this theoretical framework actually play out in the real world? Let's apply it to a few different market conditions and see what happens. Okay, so in a normal, stable market, everything's humming along nicely. Liquidity is high, spreads are tight, and volatility is pretty predictable. But look what happens as we move into a crisis. The entire dynamic just flips. Liquidity gets severely reduced, spreads widen out to extreme levels, and volatility, well, it becomes cascading and completely unpredictable. And this leads us to a really critical concept. Liquidity is pro-cyclical. It's everywhere when markets are calm, but as the old saying goes, it dries up precisely when you need it most. During a crisis, this can trigger a flight to liquidity, where all the investors simultaneously rush to sell their less liquid assets and pile into the most liquid ones, like government bonds. The result of this can be a catastrophic liquidity spiral. You get forced selling into a market with very few buyers, which pushes prices down. This can then trigger margin calls and stop-loss orders, forcing even more selling into an already illiquid market. At this point, prices can collapse based purely on these mechanical frictions, often becoming completely disconnected from a company's real fundamental value. All right, let's move from all this theory to practical application. A really common mistake for beginners is to focus only on a stock's potential return, while completely ignoring the costs and risks of just getting the trade done. Seasoned investors understand that your ability to exit a position at a fair price is absolutely paramount. First off, transaction costs are not trivial. Let's look at this. A round-trip trade in a liquid Nifty 50 stock might only cost you 0.02% in spread, but for an illiquid small cap, that cost could be 1.2%. That's a staggering 60 times higher. And this cost isn't even static. It follows a pattern during the day. It's often highest at the open, it tightens up midday, and then widens out again towards the close. Ignoring this is just a very expensive mistake. So let's just summarize the core lessons here. First, liquidity is not a constant you can rely on. It's pro-cyclical. Second, transaction costs, which are driven by these spreads, they compound over time and can seriously erode your returns. And finally, you should view a sudden spike in volatility and a widening of spreads not just as price noise, but as a critical warning sign that the underlying liquidity conditions are getting worse. And all this brings us to a final, thought-provoking question. We've established how these microstructural frictions create costs and risks for all of us. But what is their effect on the market's primary job, efficient price discovery? We're going to explore that very question in Chapter 1.5. Thank you for joining me.